Welcome to the deep dive. Our mission here is simple. We take a dense stack of sources, extract the most crucial knowledge, and arm you with the insights you need to understand the world quickly and thoroughly.
Today, we are undertaking a deep dive into what our source material identifies as, well, maybe the most powerful yet often overlooked driver of economic inequality in modern America.
Right, because when most people think about the widening wealth gap, their minds immediately go to, the usual suspect.
Exactly. Things like changes in tax codes or maybe disparities in educational opportunity. And those are huge factors, of course.
But our sources today argue that while those factors are significant, they are, in a way, secondary. The real engine, the one that has been rapidly accelerating inequality since 2008, is financial policy.
Specifically, the actions, and I think it's important to add, the profound inactions of the Federal Reserve.
So the central bank, not the IRS or the Department of Education, became the primary sculptor of economic disparity. That's a huge claim.
It is, and our mission today is to really trace those decisions, the monetary decisions, the regulatory ones, that were all made in the wake of the 2008 financial crisis. We want to understand exactly how they created this stark and ultimately bitter disconnect.
A disconnect between what exactly?
Between the rosy economic statistics that were being celebrated in Washington and the actual financial reality that was being experienced by the vast, vast majority of American households.
Okay, so let's start right there with that disconnect, with the sheer failure of the post-2008 recovery to actually reach people. The source material opens with this really poignant snapshot.
Yeah, the auto worker.
The auto worker in 2019. He'd voted for Barack Obama twice, but then he switched to Donald Trump in 2016. And when he was asked why, he just expressed this profound sense of having been completely overlooked.
And at the exact same time, you have economists celebrating what was, statistically, the longest economic recovery in U.S. history.
It's just two completely different worlds.
And that auto workers' bitterness, our sources argue, was completely justified. The economists were touting these broad brush benefits, looking at GDP growth and unemployment numbers, but that celebration was entirely misplaced for millions of people.
Because the reality was that the recovery that followed the great financial crisis was, and I'm quoting here, extraordinarily unequal.
That's the phrase. It boosted financial markets, it got Wall Street back on its feet, but it never really healed the underlying consumer economy.
And here's where it gets, for me, really interesting. Because that inequality didn't just cause social polarization or political anger. It created a profound systemic fragility.
Yes. The sources argue that by March 2020, when the COVID-19 pandemic finally arrived, that decade of rising financial markets, which was built on top of this acute economic and racial inequality, it made the U.S. economy as vulnerable to an external shock as an ill-kept nursing home is to the coronavirus.
Wow. That is a chilling analogy.
It's chilling, but it's apt, isn't it? It suggests a system that looked strong and vibrant from, say, the vantage point of Wall Street, but was actually hollowed out and brittle at its foundations.
And the foundations being the average American household.
Exactly. The pandemic didn't create the underlying weakness. It just, it blew away the entire facade of shared prosperity that the central bank had spent a whole decade trying to build.
So let's dig into that. We have this massive disconnect.
Yeah.
A central bank celebrating economic strength on one hand, and millions of Americans feeling, well, profound economic stagnation on the other. How could the Fed miss something so big?
To understand that, you have to look at their approach to measurement. Our sources call this policy myopia.
Myopia, a blind spot.
A genuine myopia. Up until the very eve of the pandemic, early 2020, Fed officials were insisting the economy was in a good place.
I remember hearing that phrase over and over. A good place.
And that confidence was based almost entirely on aggregate or average data, which, the sources argue, led to this critical statistical failure, because that kind of data completely hides the reality of acute wealth concentration and a hollowed out middle class.
This reminds me of that classic analogy, I think it's attributed to the Nobel Prize winner, Paul Krugman.
And the bar analogy.
Exactly. If Jeff Bezos walks into a bar in Tacoma, what happens to the average wealth of the patrons in that bar?
It shoots up dramatically. Every single person in that bar, on average, instantly becomes a multi-billionaire.
But here's the key point, right?
Right. None of the non-Bezos drinkers are actually any richer. Not by a single penny. They can't suddenly afford a round of drinks for their friends.
So relying on average wealth or average income in a highly concentrated economy gives you this beautiful but completely false picture of shared prosperity.
And that was the Fed's statistical blind spot. That was their myopia. They were measuring an economy that, for most people, simply didn't exist.
Okay, so while the financial markets were thriving, the vast majority of the population just wasn't feeling it. A key metric the Fed consistently pointed to before the pandemic was the low unemployment rate. Record-breaking, in fact.
It was. The headline number looked fantastic.
So how did the aggregate data mislead them on the labor market specifically?
Well, they were looking at the official unemployment rate, which is known as U3, and that number only counts people who are actively looking for a job.
Okay, so if you've given up, you don't count.
You literally vanish from the data. They were completely ignoring crucial details. They missed millions of people who were holding only part-time jobs but desperately needed full-time hours. Those are the underemployed.
Yeah.
And then, perhaps most heartbreakingly, they missed all those who had dropped out of the workforce entirely due to a lack of hope. These are the discouraged workers, people who've stopped looking because the search feels pointless. They're just gone from the official Fed data.
And when you actually go out and talk to people about their working lives, the picture you get is just so much darker than those low aggregate unemployment numbers suggest.
Absolutely. There was a survey at the height of this supposed boom in 2019. It found that nearly 1/3 of all Americans reported they were not working as much as they wanted to be.
A third of the country.
A third. Furthermore, the reported wage gains that the Fed often took so much pride in were deceptive.
How so?
They weren't really a sign of fundamental economic strength. More often than not, they were the result of more people in more families being forced to work more jobs.
Oh, so it wasn't that my hourly wage went up. It's that my spouse had to get a second job.
Yeah.
Or I started driving for a rideshare on weekends.
That's exactly it. More hours, more jobs, just to tread water. It wasn't because hourly wages had increased enough to support a comfortable life on a 40-hour week. The aggregate number looked good, but the lived reality was one of exhaustion.
When we talk about this fragility, I think nothing illustrates it better than the hard numbers on household finances. Before the pandemic hit, what was the concrete measure of how close most Americans were to, the edge?
It's a terrifying statistic. In late 2019, a staggering 37% of American adults, that's nearly 100 million individuals, they expressed fear that they could not handle an unexpected bill of only $400.
$400, not $4,000, $400.
$400. A new set of tires for the car. An emergency visit to the dentist for your kid. A broken water heater.
And for nearly 2/5 of the country, that's enough to throw them into complete financial chaos.
That's what the data says. And if you think about the implications of that...
What does that mean they're sacrificing just to tread water? Are we talking about delaying critical medical care, maybe missing a rent payment, or having to resort to really high-cost debt?
That's precisely the consequence. It proves that despite a whole decade of so-called recovery, most families were living paycheck to paycheck. They were surviving only by taking on high-cost debt. Credit cards, payday loans.
So there was zero financial buffer, no cushion.
None. The system was positioned on a razor's edge, ready to collapse at the first major shock. And that is simply not a good place for an economy to be, no matter what the aggregate statistics say.
And this issue is clearly cyclical, right?
Yeah.
Debt increases because wealth isn't growing for the majority. So let's look at the wealth metrics that the Fed's aggregate data was hiding. How did the middle class fare over the past few decades?
Poorly. To put it mildly, if you look at the period from 1989 to 2018, so the 30-year span, the real inflation-adjusted wealth of the middle class increased by only about 1% annually.
1%? That sounds pretty meager.
It's meager on its own, but then you contrast it with the 2.5% annual growth rate of the real gross domestic product over that same period.
So the economy as a whole was growing 2.5 times faster than the wealth of the middle class.
Exactly. That 1.5% delta, compounded over 3 decades, means that massive wealth accumulation was happening somewhere, but it was completely bypassing the middle of the country.
So someone was getting significantly richer, and I think we can guess too, the top 10% are the usual suspects. But what about the vast majority, the bottom 80%?
Well, for 4 out of 5 Americans, the picture is one of outright stagnation or, in many cases, decline.
Decline.
Yes. The wealth of the bottom four quintiles, that's 80% of earners, in 2016 was actually less than it was in 2001.
Wait, hold on. Say that again. Less than it was in 2001?
Less than it was in 2001. That is a 15-year period where the wealth of the majority of the country not only failed to recover from the dot-com bust and then the '08 crisis, but it actively shrank.
15 years. That is shocking. So can we drill down even further? What happened at the very bottom of the economic ladder during those supposed recovery years after 2008?
It gets even worse. When we look at the period right after the crisis, specifically 2010 to 2016, the median net worth for the bottom 20% of the population actually decreased by 4.4%.
So they got poorer during the recovery.
They got poorer. Meanwhile, over that exact same period, the top 10% became almost 25% richer. The trend lines weren't just moving apart, they were accelerating away from each other.
Which proves that the economic engine, post-2008, was fundamentally geared toward wealth concentration, not wealth distribution.
That's the only conclusion you can draw from the data.
So the question now is not just that the Fed mismeasured the economy, but why? Why did they pursue policies that actively amplified this concentration?
And that takes us to the core, the guiding philosophy of U.S. monetary policy since the mid-2000s, something called the wealth effect.
Okay, explain the philosophy of the wealth effect. It sounds deceptively benign, right? As if making everyone feel richer will make them spend more.
That is exactly the assumption. The wealth effect dictates that top-down largesse is the answer. The belief is that if you make the wealthy, who, own most of the assets, if you make them even richer, they'll feel confident, they'll spend more, they'll invest more, and their increased wealth will eventually trickle down and spur consumption and broader economic growth.
And the source material argues. What? That it worked or it didn't?
It argues that in one very narrow sense, it worked perfectly. Wealth did grow to prodigious record heights, but it was concentrated in fewer and fewer hands.
So it failed completely in that second crucial goal of creating shared prosperity.
Completely. It was pure top-down policy, not ground-up stimulus. There was no trickle-down. It was a gusher, straight up.
And the primary mechanism for this top-down injection after 2008 was quantitative easing. QE.
Yes.
For our listener, can you explain how buying bonds, which sounds so technical and frankly a lot boring, directly boosted asset prices and made inequality worse?
Sure. So QE involved the Fed creating literally trillions of dollars out of thin air to buy assets, mostly government bonds and mortgage-backed securities, from the banking system.
The intention being to inject liquidity, push down long-term interest rates, and encourage banks to lend more.
That was the textbook theory. The reality was very different. By 2015, the Fed's portfolio, its balance sheet, had swelled to $4.5 trillion. But what happened to all that money?
It didn't flow into Main Street lending.
No. Banks, which were now under new safety rules, they often just parked that cash as excess reserves at the Fed. Or they used the liquidity to invest in financial assets for their own accounts. This overwhelming demand for assets, especially long-term bonds, artificially pushed their prices up and critically suppressed their yields.
So the money didn't flow into long-term job-producing economic growth like, say, loans to startups or small manufacturers.
No.
It flowed into inflating the value of existing assets, primarily stocks and high-yield bonds.
Precisely. QE overwhelmingly boosted equity prices in the stock market. And since the wealthiest 10% of Americans own about 85% of all corporate equities, every single dollar the Fed spent on QE disproportionately benefited those at the very top.
The financial market was essentially measuring its prices by Fed policy, not by underlying economic productivity.
You've got it. It became a feedback loop. The Fed pumps money in, asset prices go up, the wealthy get wealthier, and the Fed points to the rising stock market as proof that the economy is in a good place.
And the criticism here is compounded by the fact that the lesson clearly wasn't learned. In 2020, when the pandemic hit, they did the exact same thing, but on an even grander, faster scale.
Zillions more, and the result was instantaneous. The source calls it one of the greatest wealth transfers in history.
Because the financial markets bounced back from the brink in record time, completely decoupled from the reality on the ground.
Completely. You had this bizarre situation where U.S. unemployment skyrocketed to levels not seen since the Great Depression, yet the NASDAQ stock index was hitting new all-time highs.
Which creates this permanent, self-fulfilling expectation among investors that the Fed will always backstop the financial system no matter what.
Yes, the Fed put is no longer implicit, it's explicit. And that just encourages more risk-taking at the top.
So QE was one side of the coin. The second crucial policy lever was driving interest rates so low that the real inflation-adjusted rate often fell below zero, the so-called zero lower bound, or ZLB. What did that mean for the average person just trying to save some money?
The ZLB had a devastating, deeply asymmetrical impact. For the average household relying on basic savings accounts, money market accounts, or CDs, these ultra-low rates meant, and I'm quoting, no hope of saving for the future.
Your prudent efforts to build a nest egg were just starved of any return.
Completely starved. The cost to savers was enormous. One comprehensive study estimated a total loss across the U.S. economy of $2.3 trillion in savings accounts and similar balances, just from 2008 to 2016.
$2.3 trillion.
That is wealth that was effectively transferred from small, prudent savers to large, leveraged borrowers.
But the wealthy, conversely, they were able to use this ZLB environment to actively make money, weren't they? Even if they weren't earning anything on a traditional savings account.
Oh, absolutely. They used it to their massive advantage.
What was the mechanism they used that average households just couldn't access?
They engaged in what is called the carry trade.
Okay, break that down for us.
It's a high leverage strategy. Essentially, you borrow money at an extremely cheap rate, often near 0% interest, thanks to the Fed. And then you invest that borrowed money in higher yield, riskier assets, things like corporate debt, foreign bonds, or specific equity sectors.
So you're profiting off the spread between your borrowing cost and your investment return.
Exactly. The wealthy could borrow cheaply and leverage up, reaping massive returns as those markets rose, all thanks to these Fed-subsidized low rates. The average household can't participate in the carry trade. They lack the required collateral, the credit access, and the institutional investment vehicles.
So to sum it up, monetary policy essentially starved the prudent household of returns on their savings, while at the same time it was actively encouraging excessive risk-taking and high leverage at the financial top. That sounds incredibly destabilizing.
It is the very definition of financial fragility. The Fed's policy created a veritable witch's brew. You have a large, highly indebted population that's unable to build any kind of savings buffer.
Combined with a central bank that had stripped the financial markets of low-risk assets, forcing institutions and the wealthy into ever riskier, more leveraged strategies.
Right. And multiple studies, including one from within the Federal Reserve System itself, show that a widening income share for the top 1% is the single most predictive antecedent to a major financial crash.
So inequality isn't just a moral issue or a social issue. It's a direct source of acute financial instability.
It is, and it makes perfect sense, right? If fewer and fewer people have money to spend, the real economy is more susceptible to shocks. And then the policy response to those shocks, as we've seen, only reinforces the initial inequality.
It's an endless and downward loop.
That's a good way to put it.
Okay, so monetary policy was one half of this engine driving inequality. The other half was regulatory policy. Now, after 2008, tough new rules like the Dodd-Frank Act and the Basel III capital requirements were supposed to make banks safer. How on earth did making banks safer end up harming economic equality?
It's a classic, tragic case of unintended consequences. And it's all driven by what the source calls the inexorable nature of profit maximization.
Meaning banks will always find the most profitable path, regardless of the social outcome.
Of course. So the new regulatory rules, particularly Basel III, mandated that banks hold much more capital against riskier activities. Now, what's defined as a riskier activity?
I would think something like speculative trading.
You would think. But it turns out lending to a lower-income family for a small mortgage or an auto loan suddenly required significantly more capital to be set aside than, say, wealth management services for a billionaire or lending to a massive corporation.
So the banks looked at this new regulatory landscape and just did the math. They realized that the profit margins on ordinary consumer essential loans, the kind that help people buy homes and cars and start small businesses, were now simply too low to satisfy their shareholders.
Especially in that zero interest rate environment we just talked about. The economics were completely broken for traditional financial intermediation.
So the regulated banks dramatically shifted their business models.
They did. They pivoted hard toward high-profit, low-capital cost activities. Things like wealth management for the rich, corporate lending, and commercial real estate. If you were an average American without a stellar credit history or significant pre-existing wealth, traditional bank services just began to dry up, or they became prohibitively expensive.
And this created a massive, lucrative vacuum in consumer finance.
It's a huge vacuum.
Which is where the shadow bank ecosystem comes in.
Precisely. As the traditional banks stepped back, that hole was instantly filled by non-banks and shadow banks. These are institutions that are increasingly critical to consumer credit flows. You can think of Quicken loans, fintech lenders, payday lenders, but they operate under very light touch regulation, or in many cases, none at all.
Which creates what the source calls asymmetric regulation.
Yes. The regulated sector, the big banks, they're now much safer, which is good. But the overall financial system actually became riskier because all that risk simply migrated outside the safety net. It moved to institutions that don't have the same capital buffers or liquidity rules.
And we see this migration most clearly in the residential mortgage market, which was the epicenter of the 2008 crisis.
The statistics are just stunning. These non-banks, because they were exempt from those strict capital rules, they thrived after 2008. They went from originating just 10% of U.S. residential mortgages in 2009
10%?
to a majority 51% by 2019.
Wow, from 10 to over 50 in a decade.
And this non-bank dominance was most pronounced in government-backed lending, specifically Ginnie Mae loans, which are often essential for first-time or lower-income homebuyers.
So if Ginnie Mae loans fail, the taxpayer is usually on the hook.
Usually, yes. Yet the primary lenders for these taxpayer-backed products are now these lightly regulated non-banks. The risk has been transferred from bank shareholders to the public.
So the high-cost credit still flowed to low and moderate income communities, but it arrived via these unregulated, high-risk, and often predatory lenders, which directly destroys equality by burdening people with unsustainable debt.
And we have the devastating debt statistics to back this up. Just look at student debt, which has rapidly become the nation's leading non-mortgage consumer debt. Before COVID, the aggregate student debt for millennials who had student debt exceeded 100% of their annual income.
So they owed more than they made in a year.
On average, yes. But for the least well-off student borrowers, the ones who need that economic mobility the most, the debt burden was an astounding 372% of their income.
372%.
Wow.
That's mathematically impossible to manage, let alone repay. It just locks an entire generation out of wealth accumulation. It prevents them from buying homes, from saving for retirement.
It's a trap. And the problem is ubiquitous across all of consumer finance. In the auto loan market, 22% of loans for low-income borrowers were subprime, high-cost loans, often financing low-quality used cars that will break down before the loan is even repaid.
And then you have payday loans.
The worst of the worst, short-term, high-cost products where 80% are rolled over or carried over from one pay period to the next. The system is designed to force borrowers into a debt spiral. You're literally robbing Peter, your future self, to pay Paul just to maintain solvency.
This debt burden, fueled by regulatory arbitrage, meant that millions of households were floating their entire existence on debt, not on income gains.
That's the hollowed-out economy.
And if the shadow banking system wasn't enough of a threat to equality, we now face an entirely new threat in the financial sector. Big tech companies entering the market.
Yes. The entry of massive platforms like Facebook, Amazon, and Google poses a profound and very different kind of threat. It's because they operate outside the centuries-old laws that separate banking and commerce.
They're unconstrained by those boundaries.
Yeah.
And they possess the most valuable asset in the modern economy.
Data. Vast granular data stockpiles on every single aspect of our consumer behavior.
Which means they could leverage that data in ways that profoundly exacerbate inequality. Can you give us a concrete example of that threat?
Well, big tech could practice a new, very sophisticated form of data-driven discrimination, even if it's unintentional. They could, for instance, condition financial access like offering a loan or a lower interest rate on you purchasing other goods or services from them, effectively bundling commerce and finance in a way that's been illegal for a century.
Or more dangerously.
More dangerously, they could use their vast data stockpiles to price financial services in a way that differentiates the rich from everyone else with astonishing accuracy. They know who is a good payer and who is a higher risk. This capability poses a far-reaching inequality impact because it ensures that those with high markup buying habits or pristine data profiles get preferential rates, while everyone else sees their costs for essential financial services rise dramatically. It'll completely undermine existing fair lending practices.
So the moment of truth for this fragile system came in March 2020. The system buckled under the pandemic, and the Fed deployed trillions of dollars in response. Let's follow the money here and see who is prioritized by these bailout buckets, because the contrast between the Wall Street and Main Street support is stark.
It is. The Fed became, in effect, a lender of first resort, which is a radical departure from its traditional role as merely a lender of last resort for sound institutions.
What does that mean, lender of first resort?
It means they stepped in immediately. In 2020, it established facilities worth hundreds of billions for the highest risk corners of the market. We're talking about corporate debt and even funds dedicated to buying so-called junk bonds. They weren't just propping up banks, they were propping up non-financial corporations.
Now, I have to challenge this critical view just a little bit. Wasn't it necessary for the Fed to act fast and flexibly to prevent a complete collapse of the credit markets, regardless of who the beneficiary was?
That is the core tension, and it's a fair question. Stabilization was absolutely necessary. But how they chose to stabilize the market mattered profoundly for inequality.
How so?
The Fed found all these complex workarounds to skirt the restrictions of the Dodd-Frank Act's Section 13.3, which was a section specifically meant to end the expectation of too big to fail, or TBTF.
So they bent the rules to provide these corporate rescues.
They did. And by doing that, they immediately reinforced the market expectation that the largest companies, regardless of what sector they're in, are too big to fail.
The result being a dangerous moral hazard. Markets are now certain that the Fed will always step in to protect the largest players, which just invites bigger risk-taking and bigger bailouts in the future.
Exactly. We saw companies, even awesomely profitable ones like Apple and Microsoft, benefit from the Fed's corporate bond backstops. It kept their stock prices buoyant, even when those companies were sitting on immense piles of cash and didn't technically need the help.
And the Fed justified this how?
The Fed persuaded itself it was taking no risk because the Treasury provided a sliver of risk-absorbing dollars. But this dramatically blurred the line between monetary policy and fiscal policy.
Okay, so now let's contrast that rapid, flexible, rule-bending aid for corporations with the support that was provided for Main Street. We heard the name Main Street facility bandied about a lot, but who did it actually serve?
The contrast is damning. The Fed did open a Main Street bank, but it was set up with such restrictive terms. For example, it only did business with companies that were able to repay loans greater than $250,000.
That's not a small business.
No. And it was for companies with annual revenues up to $5 billion. This was clearly not aimed at truly small businesses, the mom-and-pop shops, the local restaurants, or the average household facing acute job loss.
So the source material argues the Fed should have pursued a ground-up approach rather than waiting for stabilization at the top to trickle down. What would that have looked like?
The key prescription is the argument that the Fed could and should have opened something called a family financial facility.
A family financial facility.
Yes. This would be a targeted mechanism to provide ground-up emergency economic support directly to solvent households that were facing sudden temporary income loss. This is targeted relief, not just waiting for corporate liquidity to somehow translate into jobs months down the line.
Furthermore, even when the Fed did move to help state and local governments, a crucial public service need, it exhibited a distinct bias.
It did. The Fed was forced to provide its municipal liquidity facility to support states, cities, and counties that were struggling with collapsing tax revenues. But initially, it limited access only to the largest cities and counties.
Why?
The source argues it was an approach based on operational efficiency instead of equity. This rule effectively left out highly African-American cities like Birmingham, Alabama, and Memphis, Tennessee, which have large populations but smaller overall debt loads.
So they were excluded based on a technicality.
And it was only after significant public pressure that the Fed was forced to rethink the terms and include these smaller, often highly vulnerable communities.
So the central finding of this section seems to be profound policy inconsistency. The Fed bent the law. It found flexible, non-literal workarounds to aid giant corporations and buy corporate debt, but it was extraordinarily literal-minded when it came to providing ground-level support for state and local governments and nonprofits.
That's the heart of the critique. And all this activity dramatically ballooned the Fed's portfolio, cementing its role in fiscal policy, which is highly problematic for its independence.
How big did it get?
By early April 2020, the Fed's direct holdings totaled $6.6 trillion. And when you factor in the indirect obligations and assets it planned to buy, the total was virtually half of the entire U.S. banking system.
Half the banking system. So In effect, by printing trillions of dollars and using its balance sheet to stabilize these very specific markets, the Fed became a powerful fiscal agent of the U.S. government.
Yes, and this enormous expansion of the balance sheet, particularly in sectors that were not broadly based, it really goes against the express statutory injunction that limits Fed support to only unusual and exigent circumstances. This intrusion into fiscal policy weakens the Fed's political independence and further cements that expectation that it will always prioritize financial stability for the large players over its other mandates.
The mandates of maximum employment and price stability for the general population.
Exactly.
So after all that, is there any good news? Is this fixable?
The good news, and this is a really crucial point in the source material, is that financial policy is one of the fastest mechanisms available to change the course of inequality.
Faster than other things.
Much faster. Unlike tax reform or educational system overhauls, which can take years or even decades to show an effect, adjustments to monetary and regulatory policy can shift incentives and behavior within months.
So our sources detail some fast-acting, high-impact fixes designed to dismantle this engine of inequality. Let's walk through them.
There are three main categories of fixes.
Let's start with the central bank itself. We need to completely dismantle that wealth effect philosophy and replace it with a focus on shared prosperity, what our sources call the equality effect.
Right. So, fix number one, reorient monetary policy toward a living return and an equality effect.
What's the first step?
The first non-negotiable step is normalizing rates. The Fed must stop chasing the zero lower bound. It must gradually and consistently raise interest rates to a level that provides a living return.
A living return, what does that mean?
It isn't about crushing the economy with high rates. It's about ensuring that the interest rate is sustainably enough above the inflation rate, the real rate, to allow small savers, including prudent millennials and fixed-income retirees, to actually accumulate nest eggs and savings.
And why is that living return so crucial, practically speaking?
Because it restores the fundamental integrity of the economy. It means that hard work and prudence can actually lead to wealth accumulation again, not just relying on the lottery of asset speculation. By normalizing rates, the Fed removes that subsidized advantage that the wealthy had in the carry trade, and it forces institutions to base their investments on underlying profitability, not just on cheap debt. Without this, monetary policy remains profoundly anti-equality.
And what about that gigantic $6.6 trillion portfolio the Fed accumulated?
The Fed has to make a commitment to shrinking the portfolio back to its pre-2008 minimums, at least under ordinary economic conditions.
So it should only be allowed to grow under acute stress.
Exactly. And then only for truly ground-up, economy-wide backstops, like that proposed family financial facility. This portfolio restraint sends a crucial signal to financial markets. The Fed will not be a permanent buyer of last resort for corporate paper. It forces markets to price risk honestly again.
This also requires a fundamental shift in how the Fed views its mandates, maximum employment and price stability. How must their understanding of their job change?
They have to adopt new, equality-focused forward guidance. This means adhering to their mandates by adopting better data to focus on the nation as a whole, not just the markets.
So instead of relying solely on the aggregate unemployment rate, U3.
They need to focus on better metrics, like underemployment and the labor force participation rate for prime-age workers.
And when it comes to price stability, you mentioned that looking at average data is flawed there too.
Exactly. The Fed must measure the true costs of living, specifically things like housing, education, and healthcare, to judge real price stability. They can't just rely on misleading aggregated inflation models that often undercount the financial burden on low and moderate income households. This shift in measurement is the only way to ensure their policies are aimed at those 100 million people struggling with a $400 bill, not just stabilizing corporate bond yields.
Okay, that makes sense. Moving on to the second fix, addressing the regulatory arbitrage that allowed those high-risk shadow banks to flourish.
Fix number two, symmetric regulation.
What's the core objective here?
The core objective is to introduce like-kind rules to level the playing field. The goal isn't to punish innovation, but to ensure that profit is based on competitiveness and efficiency, not on exploiting regulatory loopholes that transfer risk to the consumer or the taxpayer.
So financial services that perform the exact same function, whether they're offered by a bank, a non-bank, or a big tech company, must come under the same safety and soundness rules.
That's the idea. If a non-bank originates a mortgage that ends up being guaranteed by the government, they should have to hold the same level of capital against that risk as a traditional bank. No more free rides.
So how do you achieve that? It seems complicated.
Well, achieving this requires a surgical tool. The Financial Stability Oversight Council, or FSOC, was established by Dodd-Frank to do this, but its process of designating specific non-banks as systemically important proved really arduous and highly political.
So there's a better way.
A much better and faster approach is to use the FSOC to designate risky activities and practices, not just specific firms, for symmetrical regulation.
What kind of activities are we talking about?
We're talking about things like highly leveraged lending, high-risk non-bank consumer finance, proprietary trading. By regulating the activity itself, you apply the necessary safeguards across the entire product, regardless of which institution offers it. This prevents that risk migration we talked about and closes loopholes swiftly.
And finally, to truly end the moral hazard that invites market bailouts, we have to restore market discipline at the top.
We must mandate sure and certain failure for firms that take undue risk. The implicit too big to fail expectation that non-banks currently enjoy must end. If a non-bank relies on taxpayer-backed benefits like access to the Fed's payment systems or government guarantees on their loans, then they should be immediately subject to bank-like capital and liquidity reserves.
Because the government cannot socialize risk while allowing profits to be privatized.
That is the fundamental engine of inequality and instability. That has to end.
Okay, that makes the shift from regulating firms to regulating activities sound like the most practical regulatory fix. Let's move to the third category, structural changes to the financial system itself.
Right, so fix number 3, equality-focused banking and digital money.
This sounds like going on offense. Not just fixing what's broken, but building something new.
That's the idea. Beyond simply fixing the existing framework, the source proposes constructing entirely new institutions and embracing new technology with equality in mind from the start. The first idea is the creation of equality banks.
What would be the mission and function of these special purpose institutions?
These would be new private institutions, but chartered with an explicit, legally mandated mission to enhance economic equality.
So what would they do?
They would focus on providing low-cost financial services to LMI communities, underwriting small businesses, and facilitating home ownership for first-time buyers. And in exchange for this stringent public service mission, they would receive specific regulatory breaks, for example, on certain capital rules. But, and this is key, they would be subject to enhanced supervision and measurable performance goals related to community service and equality-enhancing finance.
So this sounds like a way to mobilize private capital toward a social good, but under a strict mandate that prevents profit maximization from overriding their core purpose.
Exactly. It provides a mechanism for injecting financial resources directly into the struggling parts of the economy without having to rely on that trickle-down myth.
The final and arguably most forward-looking piece of this involves the inevitable shift toward digital currency, the creation of an equitable central bank digital currency, or CBDC.
This is critical because of that looming threat from big tech. If companies like Facebook or Google launch their own platform-specific digital money, they could leverage their platforms to control the digital financial landscape and further exacerbate that data-driven inequality we discussed earlier.
So the Fed has to get in the game. It must develop its own digital dollar, a CBDC, that enhances inclusion and speed. But it has to be designed correctly. What is the most important feature of an equitable CBDC for the average American?
It absolutely must be token-based. This is essential because low-income households rely far more heavily on physical cash than wealthier Americans do.
So a token-based CBDC would act more like digital cash.
Precisely. It must be designed to be converted to physical cash on demand, guaranteeing financial inclusion for those who rely on cash transactions and also ensuring privacy standards similar to cash.
And how would this equitable CBDC function without creating this huge nationalized banking system that's run solely by the Federal Reserve?
The digital dollar must integrate securely with regulated banks and new technology. The Fed would manage the central ledger, but the actual accounts and customer interaction would still be handled by private banks, including these newly chartered equality banks.
So it's a public-private partnership.
In a way, yes. It enhances payment speed and inclusion for all Americans, providing a safe, low-cost option without transferring the entire retail banking system into the hands of an unchecked government bureaucracy. It's about creating a safe, neutral digital utility that limits the power of both unchecked big tech and unchecked government.
So to wrap up, we've uncovered this financial engine of inequality. By focusing policy on the wealth effect, relying on flawed aggregate data, and allowing the regulatory landscape to create these massive loopholes for shadow finance, we built a system that was not only unequal and angry, but profoundly fragile.
The cost is clear. Wealth accumulation now relies overwhelmingly on owning existing assets, on financial speculation, and on subsidized risk-taking, not on hard work, diligence, or savings. And as the source material really drives home, inequality is not just socially polarizing or morally wrong, it is a fundamental source of financial instability.
It creates what you called an endless and downward loop. Highly unequal nations recover slower from shocks and are infinitely more prone to recurrent financial crises. By ignoring the financial struggles of the majority, the Fed ensured that its monetary signals fizzled out, which then necessitated ever larger, more drastic, and more unequal market interventions.
Like the ones we saw in 2020.
Exactly.
And fixing this inequality engine is vital for stability, but the source makes it really clear that the mechanics of change are fast. Financial policy can be adjusted swiftly. The core challenge is not technical, it's political. It simply requires the will to act.
And that brings us to our final provocative thought for you, the listener, to mull over. We learned that in 2020, the Federal Reserve found workarounds, flexible interpretations of Section 13.3 of the Federal Reserve Act, to aid giant corporations and buy corporate debt. Yet it was extraordinarily literal-minded when it came to providing ground-level support for struggling state and local governments and nonprofits, often excluding highly African-American cities and essential community groups until it was forced to change.
So, if the mechanism for fixing this inequality engine is simply a matter of political will, as our source material suggests, how can accountability be enforced on an independent central bank, an institution designed specifically to be shielded from politics, to ensure it truly serves the common good and its four legal mandates? Maximum employment, price stability, moderate interest rates, and financial stability, instead of perpetually serving just the financial markets. It's a tension that sits at the very heart of American governance today.